for every Bitcoin that's being used as a digital gold, can't be used as a remittance asset. And for every Bitcoin that's being used as a remittance asset, can't be used as protection against arbitrage. Asset classes. So first off, if you believe that crypto broadly is a distinct asset class that's also going to affect other asset classes, then you'd imagine that, in the next few decades, it is going to be on par with other asset classes. So, we've sort of sized the opportunity as in the next 10 years as being, a 25-fold from where it is today, which would amount to about a $28 trillion market cap. But in the context of global equities and M2 and global bonds and real estate, that's actually still only a fraction of the broader kind of asset class base. So with that, the $1 million does sound, quite like an insane number to throw around. And so you can kind of make the argument again that Bitcoin is going to challenge gold as a global store of value. You can see in the opportunities slide that we actually estimate that Bitcoin will, in the gold use case, only capture around 50% of gold's market share as a digital store of value. But I'd make the argument that, Bitcoin is a 100x better version of gold. It's more portable, it's more divisible. Every marginal kind of individual who's transitioning from the physical to the digital world isn't thinking about buying gold. I've never considered ever buying gold, and yet every chance I have, I buy Bitcoin. So there is kind of just a shift in the mentality of these kind of next generation asset holders. But with that being said, it is a big number. It is relative to when we first sized the opportunity, though, a smaller jump. So we actually first gained exposure to Bitcoin in 2015 through GBTC when Bitcoin was trading around $200. And at the time, we had predicted a $50,000 price. And you'd imagine like a $200 to $50,000, you must be absolutely absurd, right? That's a 200x from here. So, we're effectively predicting a 50x to, a 50,000 to $1 million price, which in relative terms is a 20x. So actually an order of magnitude less than kind of the previous predictions that we've had. I think that the main takeaway from sizing the opportunity broadly and how we think about it is Bitcoin's use cases, given it is a monetary asset that has a fixed supply, are additive, right? So there's a fixed 21 million Bitcoin supply cap, which means that for every Bitcoin that's being used as a digital gold, can't be used as a remittance asset. And for every Bitcoin that's being used as a remittance asset, can't be used as protection against arbitrary asset seizure. So when you combine kind of the 21 million fixed supply with the fact that that supply itself is becoming more and more longer term focused, where people are buying and never, adding to and never willing to sell, then the price multiplier as well increases, where now for every dollar that flows into the asset, the reflection on what that looks like for market cap is not necessarily $1. It might be $10, it might be $25. So the point is that for many of these use cases, specifically for the nation state treasury and for the corporate treasury, we have assumed a price multiplier where you look at kind of the liquid supply that's available in Bitcoin, and you just take that as kind of the denominator set that's absorbing, new demand. Right? I look at Bitcoin as like what many people call like a Veblen good, which is a good that actually the demand for the good increases as the price increases. So like, luxury is considered a Veblen good. But more than that, it's like if you employ Bitcoin as this long-term asset where the number one rule of Bitcoin should be that you forget that you own any Bitcoin, then by definition, there is a supply shock that isn't necessarily priced in today. In 10 years, if you have nation states competing on, amassing Satoshis, then every dollar that's going into Bitcoin is going to be sucked up by a subset of that 21 million fixed supply. So there is definitely a case to be made that the more we see nation state adoption institutions, and the more that it's seen as less of a speculative bet and as a long-term investment, then we might see this kind of fly based on just small inflows. And even if we don't see the small inflows, and I'd urge you to read it for the audience, our white paper that was published a year and a half ago that details some of these use cases, including economic settlement network and digital gold and seizure resistant asset. These are all, I think, pretty reasonable estimates. If you do believe that Bitcoin is this global monetary asset and really kind of a generational opportunity to really put your foot in the ground in the digital world as the economy, like how we get to, let's say, the 2.5% or the 5%, right? I think to your point, all of these are taken from initial signals that we've seen the market throw at us, right? If we see a Tesla allocating 8% of their balance sheet into Bitcoin and a Square and a MicroStrategy, it's like, okay, is there a trend that's emerging? So for the institutional investment, we conducted a Monte Carlo simulation that basically asked what is the optimal portfolio allocation of Bitcoin for an investor, a traditional investor that has exposure to all asset classes, from emerging market currencies to real estate to bonds to equities, that would like to basically either minimize volatility of their portfolio or maximize their risk-adjusted returns. So what percent of Bitcoin should they put in their portfolio to achieve one of those two optimizers? The 2.5% is basically to minimize the volatility. So we basically took the last 10 years and saw the returns of asset classes, including Bitcoin, and said, okay, what percent of Bitcoin would need to be allocated into this portfolio? The answer was 2.5%. This was actually the lower bound. The upper bound was 6.5%, where to maximize risk-adjusted returns, an investor should allocate 6.5%, consistent with the asset class returns that we've seen in the last 10 years. Now, of course, this is in hindsight. So there's also an analysis that we conducted on a prospective basis, where it's like, okay, if we were to size the opportunity, what would that look like? That ranged again between 1% and 7%. So this is really like, if you pitch to an institutional investor of, look, you're a strategic allocator, you want to minimize the correlation of returns across your asset classes, adding Bitcoin to your portfolio is going to do exactly that. I don't think it's necessarily a tough sell for institutions. The seizure resistant asset is another good example, where we take the use case of Bitcoin, where with good public and private key management, Bitcoin isn't a seizure resistant or unseizable asset, right? If I'm custodying Bitcoin on cold storage, unless like someone comes knocking on my door and takes physically my private keys, there's no way for anyone to seize my Bitcoin. And as such, you can see it as really an insurance policy against arbitrary asset seizure, whether that's through indirectly through inflation or directly through the outright confiscation of wealth or the freezing of bank accounts like we're seeing now in Canada, like we saw during the Hong Kong protests. And there, the 5% estimate is really, us estimating what the probability over a lifetime would be for an individual to have their assets seized. So you can say on any given year, it might be 1/1000th of a chance. So over 50 years, you multiply that, it's about 5%. So we're effectively equating that 5% to the probability that your assets might get seized over your lifetime. And as such, a sensible allocation should equate to that probability. So you take the $80 trillion of global high net worth wealth, you multiply that by 5%, and it gets you that $4 trillion opportunity alone. So that's kind of the rationale and some of the logic that we employ going through these different opportunities.